Okay, folks, we're going to start broadcasting. Morgan, I guess you know how to live stream. You're usually in class. Savannah, I think, will be here for taxes today, but not here for cost. Clayton, probably his electricity was out and he just slipped in. The what?
It normally shows up a couple minutes late.
Yeah, Clayton may be here. And of course, Terry's live streaming. That accounts for everybody. I got a nice little gizmo here. Right here. I call it Gizmo. Now, it takes the place of that overhead machine we had in the other rooms. I had TurboTax installed on my computer yesterday. You have to have an administrator if you install anything. They're afraid we'll install porn or something. But anyway, I was mentioning the overhead projector. So he brought this little gizmo over. All you got to do is plug it in. And that takes place of that old big projector we used to have. And so if I want to show an exercise, somebody don't have the book. If I want to write assignments here instead of on Notepad, or if I've got some document that I need to show you that's not on Notepad, and so forth, this little gizmo comes in handy. And it also has a place I can switch the camera if I want to, or I can move this arm in and out. So that's a good little gizmo. Okay. And of course I can write here. See, I can write here instead of on Notepad if that's what I prefer. So, but anyway, I told Mr. Amelbach that I think he's asked them to try to get more for other professors. They have to install simple software on your computer. That's it. And then all I have to do is unplug this and take it to my office in case somebody wanted to take that home. I'll have to put it in my office so somebody can't take it home. Now, this thing folds up, it'd be easy to conceal in your jacket pocket, your backpack. Not saying that anybody would steal it, but remember internal control. Yeah, always remember internal control if we do something to protect our assets. All right, I'm going to try to bring up a few solutions on chapter 2. I'm getting too much on here. Find it fast. I don't like that. Okay, we're in chapter 2, and we need to move on. Chapter 2 had a lot of journal entries in it and a manufacturing statement. That's the two main things I want you to get from chapter 2. And I think I gave you some practice on both of those for homework. So we're going to look at those, and we will probably move on today to another chapter. Okay, Jonathan, what problems did I give you for today? Exercises?
52.
That it?
Said 52 and 50 turn in, and then you just said 35. Just look at it.
All right. Now, you folks out there in viewing land, wherever you may be, I hope you email me today. There's 5 of you since Clayton's out. Email me today. those solutions to those problems. But let's look at, was it 35? Now that's journal entries for a service business. Okay, we used 8,000 of previously purchased supplies on audit. Now, doesn't matter what kind of business it is. Now, if we use supplies, what do you think we would debit? If we're not making adjusted entries, what do you think we'd debit for that one? And we're on page 52, problem 35. Now, if you use supplies, would you want to debit some kind of expense? All right, and credit what? Now, however, I don't know how they're accumulating these costs, so I'm going to run down real quick. All right. Now, Jonathan started to say inventory. Did you say what kind? All right. Now, we're using cost techniques, materials, labor, and overhead. Now, the funny thing about this, it's a service business. And now in a retail business, we would have debit supplies expense and credit supplies inventory. So your credit to supplies is right no matter what you're doing. Factory, retailing, or service, okay? But here, we're going to put it in the work in process. Now, what kind of business is this? All right. Their CPAs, they incurred the following costs in performing audits during September. The firm uses a work in process inventory account for audit engagement costs and records overhead in fixed and variable amounts. All right. So how about the second one there? Paid 8,000 of partner travel expenses to an accounting conference. What do you think, Monique, on that one? And credit what?
Yeah.
All right. Now that's all you can do on that one. Debit travel expense and credit cash. That has nothing to do with the audit. Recorded 6,500 depreciation on laptops used in audits. All right, now what do you think we're going to debit for depreciation? It'd be overhead, wouldn't it? Depreciation is fixed, isn't it? And we credit, of course, accumulated depreciation. All right. Now we've got recorded annual depreciation on the building located downtown. So that is a selling or administrative expense. What do we debit? What do we debit for a home office depreciation? Depreciation expense. And you credit accumulated depreciation. I didn't read far enough to see that they broke it down into fixed and variable. So let me read that one again. 65% of the space is used in-house audits. 65% of the space is used to house audit personnel. All right. What is 65% of 150,000? Is that 97.5? So if it's used for the audits, then we put it in fixed overhead. The rest of it, like Johnson said, depreciation expense. All right, we got accrued audit partner salaries of 200. Where do we put that at? Where do we put the partner salaries? All right. If they're working on audit, it goes in work in process. Then salaries payable. So far, we've accumulated supplies in this audit. We've accumulated depreciation because of this audit. And we've accumulated more depreciation. and we've accumulated more work in process. Well, you think these are big amounts. I don't know if it's one audit or a bunch. But Enron was paying one of the big six accounting firms $1 million a week just for advice. That's $52 million a year. And the audit probably was included in that. But the big six accounting firm didn't do their job and they went out of business. Some of the other accounting firms hired them. So, and my daughter, she worked for one of the big six out in St. Louis. They sent her everywhere. She audited cement companies. She audited heavy equipment companies. And when she audited construction companies, she had to go out on the side and get the numbers off of those dozers and big trucks. She audited nursing homes and got harassed by a lot of old men. But she loved it. She got to travel a lot. But now, when she had to audit accounts receivable like of a nursing home, her firm may only give her 10 hours to do that in. That's what she'll report 10, even if she went over to 12. And I think that's a bad thing if they encourage their employees to put down what they estimate. Because if you go over their estimated amount, think, well, they're going to think I'm slow. And so you put down what they estimated. She saw that as a flaw in the system. All right, accrued remaining audit staff salaries. We got the same deal here, work in process, salaries payable. All right, we paid credit card charges for travel costs for client engagement. Now that's going to go into work in process too, isn't it? All right, now this is credit card charges, but it was travel to get to the audit. And she was on a lot of planes. So you can see this travel can mount up, but she was in a lot of planes to 39 states and about 100 cities. She was also in on the audit for Anheuser-Busch, a beer company. And she was in an audit for Eagle Snacks, which supplies those snacks for airlines. So she had some interesting companies. All right, 1 month's prepaid insurance and property tax expired on the downtown building, 17-3. The downtown building, is that for the audits? Or do we have to take 65% of that? Let's look at it. It looks like we take 65%. 65% of it's going to be factory overhead fixed. Now on the company part, that's insurance expense. So the audit used it and the company used it, so 17.3. Accrued 3,400 of office assistant wages. The office assistant works only for the audit partner and staff and paid all the accrued salaries. Okay. That's variable overhead, wages payable. And then of course we paid the salaries and wages payable. We paid just 3,400. We paid all this other amount up here. We paid this 200. We paid just 257.9. All right, now let's look at what we have here on 35. We have supplies. We have salaries. All right, so we got labor. So look, we got materials, some kind of materials, and we got labor, and we got overhead. We've got the three ingredients that a manufacturer would have. Produce an automobile or a computer or what have you, okay? still got the same three ingredients for service business. So you see, these skills can be used construction, building trades, service business. Let's say you're a Maytag repairman. You're gonna have materials, aren't you? You're gonna have labor, you're gonna have overhead in a service business. You got an automotive repair shop. You got materials, labor, overhead. Okay. All right, so this was a good little problem, getting away from a factory. Now I want you to do what other upon 53 and 52?
Yeah.
Right now for Tuesday, I want you to do problem 44. This is journal entries for a manufacturing company. So we need to look at more journal entries. Number 52 and 54. I want you to do number 47. Number 44 and 47, folks, I want you to do for Tuesday, and read chapter 3 for Tuesday. That'll be your assignments. Now let's look at your today's assignments, number 52. Now, you know I'm really concerned about you being able to do a manufacturer statement and a cost of goods sold. So number 52, time we answer A, how many units did the company sell? Prepare a schedule of cost of goods manufactured. Okay, I'm interested in every question here, of course, but I'm interested in the statement. All right, Cole, did you figure out how many units were sold?
200 units.
200 even?
Yes, sir.
All right. Now, trying to look at the wrong problem. How many units did the company sell? I'm trying to see, ending inventory was 30 units. Did you have any beginning inventory? Okay, Cole, how did you calculate 200 units?
So the sales on account was $1,040,000. And you divided it by the $5,200, which was the unit price.
Unit price. All right. So you had sales of 1,040,000. You divide that by the unit price of 52, and you got 200 units sold. Okay. Now see, a lot of time we got to know our manufacturing costs before we can set this 5,200 selling price. Now the second part is to prepare a schedule of cost of goods manufactured for July, no matter what the year. Monique, what'd you get on that one?
746,000.
All right. Okay, she hit that one. No beginning work in process inventory, right? WIP. Direct materials. Now, did you have to take beginning materials plus purchases minus ending materials? Or did it tell you straight out? Huh?
They told you.
Direct materials issued to production, 377. It told you. Direct labor, it told you. Now, they give you all the overhead listings. So you got manufacturing costs. Now, it gave you beginning inventory of 0, ending inventory of 51. So your cost of goods manufactured, 747,000. And you know, you're in business to make money, right? Nobody stays in business just for the pleasure of it. Okay? Now, here, your sales is $1 million, right? But your cost is 747,000. But now, you see, that's not the whole picture. If we take away cost of goods sold, we still got some period cost. So that period cost gets you. Now on this one, how many units were completed in July? How'd you work that one out, Jonathan? C part.
Right there at the, says ending finished goods inventory 30 units. So then you'd add your 30 units to the 200.
You had no beginning, right? Okay. I sold 200 units. I've got 30 left. So I must have had 230 to start with. So that was not too complicated. Now they want the cost per unit. What was the per unit cost? Now you can see that right here. Divide your cost here by your 230,000 units. That gives you 3,250. But something's bothered me about that. We may bring it out in a minute. What was the cost of goods sold in the first month of operation? Okay, what is question D? Jonathan, what is question D?
What was the per unit cost of goods manufactured for the month?
I'm not going to agree with this. You know why? Wait a minute. Wait a minute. We finished 230. I may agree with it. We finished 230, didn't we? At this cost. Okay. I don't know how many units is here. Here's what I'm concerned about. Later on, we'll have to convert that to equivalent units and use that in finding your unit cost. All right. So we found a unit cost of 3,250. So your cost of goods sold would simply be 200 times 3,250, wouldn't it? Now sales minus cost of goods sold gives you gross profit. And gross profit minus period cost gives you net income, don't it? Okay. All right, now, number 53 was some journal entries. And time we look at those other two problems for homework, journal entries. So there's two things I want you to get from this chapter. Journal entries, manufacturing statement. All right, here's your manufacturing statement. Okay. That is your manufacturing statement. We're going to practice journal entries till we get a little bit of a handle on them. Okay, raw materials was purchased on account. We know we debit materials and we credit accounts payable. Now, are they putting these in T accounts? Now, you did not have to put these in T accounts. Did you make a T, Jonathan, or a journal entry? Yeah. What'd you do, Monty? You did T accounts, like they said, Jonathan, T account code. All right. Had I noticed that they wanted T accounts, I would have told you to make journal entries. So now I've got to trace down your debit materials inventory, you credit what? Accounts payable, which they don't have a T for. All right. Number two, you debit direct materials, and I guess since you credit materials, what's the other number here? Here's right, these two added together. These two added together. So you were debiting work in process, and then you're debiting overhead for the 15, and you're crediting materials for 136. Now you're going to debit direct labor, and you should credit salaries payable. You're going to debit factory overhead for the IL, indirect labor, and credit salaries payable. You're going to debit manufacturing overhead and credit utilities payable or cash. You're going to debit factory overhead and you're going to credit accumulated depreciation. Same thing for rent. You're going to debit factory overhead and you're going to credit rents payable. All right. Now here, what's BB standing for here? Beginning balance. You had a beginning balance. Now, where did we get cost of goods sold of 502,740? All right. Anybody get that figure, 532,140? Well, you got to take your materials, labor, and all your overhead. All right. That is materials, labor, and overhead. Add your beginning, subtract your ending, and that would give you this amount. All right. Now, would somebody add all these together right here? Add all your debits, except this one. All right. What'd you get, Jonathan? If you add up all these debits, huh?
Just adding all the debits?
Yeah, you didn't add this one, though, did you?
No, I subtracted that.
Okay, you add them all up and subtracted this one. Or if you add them all up and subtract it from what you sent out here, it would also give you the ending inventory. You could work either way. So here, take 24,000 plus 532,140. Take 24,000 plus 532,140. What does that give you? How much?
56,140.
All right, there's your beginning inventory plus your cost of goods manufactured. Now minus your ending inventory. That gives you, it gives you cost of goods sold on it, which is CGS. All right. Now, if you got period cost, office salaries, utilities, depreciation, rent, period cost, you've got 195,060. Now, We don't know what sales is in this problem, do we? We just know our cost of goods sold. All right. Now let's say sales is 1 million. All right, let's take 1 million sales. Find me gross profit and then net income. You got 1 million sales. You got cost of goods sold. You got period cost. So find me net income. Okay, you took 1 million minus cost of goods sold. That left you how much? 497,260. All right, now you subtracted other costs from that. Subtract the period cost from gross profit. And what is your net income?
302,000.
You had 400 and something left. All right.
302,000.
You had 400 and something left. You're taking about about 300,000. That would be net income. That would be put in your pocket, put in the bank. But I just made up some figures there. If you have these, I'll take them. The rest of you can email those to me. Well, hey. All right, you've got your assignments, and we're going to take a peep at chapter 3. Some days that works, and some days it don't. Okay, this chapter is about predetermined overhead. That's where we find a rate. Now, in this chapter, you're going to take estimated factory overhead. It don't matter if I call it FO factory overhead or MO, manufacturing overhead, what have you. But the fact is, it's factory overhead. And you're going to divide that by some base. Now, that base is probably going to be direct labor cost or direct labor hours or machine hours. That's going to be your base. So once we learn to calculate that, then when we got a factory overhead T account, now you went down through in these last problems, you might put in depreciation, $5,000. And you might put in utilities, 1,000. You might put in indirect materials. You might put in indirect labor. So you've got a lot of debits to factory overhead. I'm just saying one overhead. I'm not breaking this down into fixed or variable, which we could do that. But now here, I've got 6, 7, 8, 13,000 of actual overhead. If we knew that, we could debit work in process and credit factory overhead. If we knew that. We don't know that. But now, if we had some kind of rate here, like based on direct labor hours, and anyway, if estimated factory overhead was 100,000, and estimated direct labor hours was 50,000, what would be your predetermined overhead rate? 50 into 100 is what? $2. All right. Now, what if we had 6,200 direct labor hours, and we use this predetermined rate times 6,200 hours? What is 2 times 6,200? All right, then we would debit work in process 12,400, and we'll credit factory overhead 12,400. Naturally, we're going to have a balance here of 600. We got to get rid of that. So we credit factory overhead in adjusting type entries. We will credit factory overhead 600. Now we can put that in to cost of goods sold. Usually we will, or work in process, or finished goods, because we got to up some cost somewhere. So that's underestimated factory overhead. So that's what the chapter is. So take a peep at page, I won't bring up PowerPoint. Maybe I will. PowerPoint on this thing is almost like flipping pages in your book, but it's a little different than flipping pages in your book. Okay, Jonathan Cole, in accounting, you just have Mr. I'm on me, right? You don't have this new part-time instructor? Yeah, I think our seniors has him. He had to pick up Mr. Amel's auditing and finance, some kind of financial course. He's Michelle Kofer's husband. Okay. He got his master's in accounting, I think, from West Virginia U. And he does everything for Cole Motors, from their cost accounting if they got repairs, to their general accounting, to their payroll. I guess he does it all.
Is he gonna like become a full-time teacher?
Jonathan, I'm going to guess they got to go through committees here. I'm going to guess that he would have a shot at, when I leave, at taking my place.
When's that gonna-
Not too far in the future. 51 years is quite a long time. But I started working when I was in 7th grade at a sawmill in the summer. So then in high school, I worked for, it was Piggly Wiggly at the time, not Food City. I worked for them. I worked other odd jobs. I worked for a grocery store called Modern Supermarket. Then even when I went to college, I was a student worker at UVA Wise, and I was a professor assistant at East Tennessee State. So I worked all year long. In the summers, I went to Detroit and worked at Chrysler's one summer. I went to Detroit and laid carpet one summer, maybe 2 summers. And I worked for a big rock coal company one summer. So I worked every summer. And so I worked a lot of years since I was 13. Okay. All right, predetermined overhead rates. Now, absorption costing is something you've always done. That's what we've been doing. Absorption accounting. We'll learn a little bit about variable and flexible budgets. Actual versus normal, product cost. But now when it gets to your overhead, here's actual that we did in chapter 2. But chapter 3 is predetermined overhead, okay? All right. Now, total budget overhead divided by activity level, usually for a year. And we're using direct labor hours. Now, you can use direct labor dollars, or you can use machine hours, but you are using direct labor hours. All right, here's total variable overhead. Now we're gonna break this down too. Variable and fixed divided by machine hours. And your variable overhead is $750 and your fixed is $1260. That's a total of $19, $20 and $20.10 or something like that. Applying variable overhead activity level, 4,300 actual machine hours, predetermined rate, $750. So your applied overhead is $32,250. That's when we debit work in process and credit variable factory overhead. Now, your actual factory overhead, you had been debiting factory overhead and crediting accumulated depreciation, or crediting salaries payable, or crediting materials. So here's your actual overhead. Here's your applied overhead, your variable and your fixed. That's what we put in the work in process. What are they doing there? I didn't. Record actual overhead, variable fixed. That all they're doing is just recording this. All right, now add your debits and credits, folks. Add your debits and credits on that T account. What you got?
87,000.
All right, right here. Now add your credits.
86,400.
Now take the difference. Only not what, 900 and something?
955.
All right. Now if this was actual and this were applied, let's see if we got some common sense here. Is it over or under applied? Common sense, folks, kick in. This is your actual. This is your applied. Is this over or under applied? Is it smaller than actual?
Yeah.
All right. Common sense didn't kick in too good. Okay. Underapplied, 955. We gotta get rid of it. We would debit cost of goods sold and credit factory overhead for 955 to make it balance. All right, but they didn't show you that. They're showing you this. Actual is 220 and applied. Now, common sense, let's let it kick in. I don't believe I can block that. Common sense, let it kick in. That's 40,000. It's going to be what? Over or under? Oh, it's going to be what? All you got to do is look down a little bit. Okay. All right. Now, what are we going to do with that 40,000? We got to get rid of it. If overhead is underapplied, the adjusted entry increases cost of goods sold, and if overhead is overapplied, the adjusted entry decreases cost of goods sold. So we debit or credit cost of goods sold to make that balance. But now if it's material, we got to take a ratio, and we may allocate the work in process, finished goods, and cost of goods sold. If it's big item. All right, there's a couple of terms here, right here. What is the most hours a manufacturer could produce? What is the most hours a factory could use per day? 24. 24 hours per day if you want to run 3 shifts. Coal mines used to run 3 shifts, didn't it? 8 hours a shift. All right. But all production factors disregards machine breakdown, holiday downtime, significant underapplied overhead, what it results in. All right. Now, normal capacity based on the history of the business. Now, expected capacity, these companies always expect more, okay? Now, if you're producing, all right, in theory and in practical, normal. Now, in theory, we may be able to produce 100,000 units. Practical, let's say, hey, we can only produce 80,000 units. But normal capacity, all we've ever produced is 75,000 units. That's normal. So theory, expected, normal capacity. Activity levels for the upcoming period determined during the budget process. Okay, mixed cost. I know you can handle an algebra, a little algebra formula like that, can't you, Jonathan? Yeah. Y is equal to A plus B times X. All right, I don't even know if I'd want to call that algebra or not. All right. But we could even do it easier than that, I think. We're going to use the method of high-low to separate cost. We're going to practice that in class on Tuesday. Once we wrap up the 2 problems for homework on journal entries, we're going to read the chapter. We're going to get into the high-low method on Tuesday. I'm even going to try to work it today. Well, here we're going to have to do budgets, and we'll look at those also on Tuesday. All right, we're going to look at the number of machine hours. What is our budget if we work 50,000? That may be normal. What if we work 40, or what if we work 75? Now, we know that some things down here, no matter what level, fixed is going to be the same, right? Fixed is going to be the same. Fixed is going to be the same. Fixed is going to be the same. So what level do you want to work at? Variable factory overhead is the same. Where would you make most profit at? 75,000 or 40,000? Come on, where do I make the most profit? Huh? At 40?
What are you talking about?
Where do I make the most profit? At 40,000 units or at 75? Okay, one thing I want you to remember, rest of your days, okay? Fixed cost is the same no matter what. If your sales is $1, your fixed cost is still gonna be 630. If your sales is 10 billion, your fixed cost is gonna still be 630. So the more production you can get, the better it is because it lowers your fixed cost per unit. For example, divide 75 into 630, you get 840. But over here, what was your fixed cost a unit? In economics, do you remember economics of scale? Have you had economics? Out of Missouri didn't teach you all what economics of scale is?
I don't remember hearing about it, but I don't remember what it is.
Well, economics of scale, that started way back in mass production. But economics of scale is the more you can produce, cheaper you can sell it for because your fixed cost is lower. That's where you get economics of scale. All right, let's call it a day. Be careful going home. The snow that was on the grass has melted. Never was any on the road. Nobody should have missed class today.